Well, the market is, to say the least, a bit shaky. Interest rates have taken a dive. Where can you be sure of a decent return? You might want to consider life insurance. Yes, life insurance. Well, Joe, I'll start with you. Explain why you think this should be a new asset class for individuals, because we did hear that same thing a few years ago with commodities, which were then not an asset class for the general public. And it's turned out to be a big bet for a lot of people and a good one for people. Why life insurance now?
Well, it's simply taking the commodity that banks, corporations, and college endowments have been utilizing as a safe bet, long-term investment with high interest rates, virtually no volatility, and liquidity. And now we're simply looking at this as a potential for play for a portion of our clients' money and portfolios for safe long-term money.
And Adam, you agree that life insurance should be part of your portfolio. How much? What kind of a return should you expect too?
Well, Sue, in today's volatile marketplace, with money markets at 2% and 5-year CDs at 3%, the current crediting rates of permanent life insurance policies are now. So depending on the size of a client's portfolio, like anywhere between 5 to 10% allocated to this new asset class.
Dennis?
Wow. Hey, Joe, simple
Yes.
question. Do I have to die to reap a really good return on this investment?
No, you don't. That you pay no income tax on those gains ever if it's structured and the withdrawals are done properly.
Can I spend those gains, though, as I'm going while I'm alive, or could you spend those gains only after the policy pays off?
No, you can spend them while you're alive, which is the utilization that companies and banks have been utilizing for decades now to fund employee benefits and retiree benefits. Possible. The reality is, just as Adam mentioned, we're talking about 5 to 10% of our clients' portfolios in safe investments such as life insurance. So we're a big believer in the market. I'm not looking to scare clients. I'm just looking to talk about alternatives.
Okay.
Adam, do you worry, though, about some of the exposure that companies might have to some of the current problems? AIG obviously is a very kind of a different animal, but they are an insurance company, or part of them are, and they're having issues.
Well, general accounts, and this is what we're talking about, permanent life insurance policies. AIG is a little bit of a different animal because they have a property and casualty division, but a traditional life insurance company is limited by statutes as to how much money they can maintain in the stock market. And if I recall, it's about 20% in today's environment. So most of these portfolios are very conservative. A lot of treasuries, government bonds, some high-grade corporates as well. So we feel pretty comfortable that these returns are solid.
Okay, thank you, gentlemen, very much. Joe, Adam, a pleasure. Dennis,
Thank you.
I'll see you again in just a second.
Do you have a tax-free retirement plan? Or are you investing in a qualified retirement plan like a 401k, 403b, or 457? The only other way to get a tax-free retirement is through life insurance. And when I mean tax-free, I mean at the age when you retire, can you pull the money out without paying income tax on that money? And I just showed you the two ways of doing it. Why do you want to invest in a tax-free retirement plan? Well, we feel that in the next 10, 20, 30 years, income tax brackets are going to skyrocket. What I want to talk about is this book by Patrick Kelly, and it's called Tax-Free Retirement. I recommend you guys read this book. In the book, it states that if someone were to contribute $100 a month into a retirement account over a 30-year period, that person would have contributed $36,000. At a projected 10% growth rate, that $36,000 would grow to $226,000, a 528% total return. If income tax rates went to 30%, they would pay $67,000 in taxes on that $226,000 gain. People always ask me, they say, Dan, you know, if this plan was so good, how come everybody's not investing in it? And I want to tell you the reason why most people aren't investing in this plan is because they don't know about it. And the reason why most people don't know about this plan is because life insurance agents, most of them don't even know this plan exists. This is a life insurance retirement plan, and most life insurance agents deal with strictly life insurance. So they don't have any education on this plan, and a lot of them don't know it exists. Your financial advisor, your financial investor, they have no clue about this because this is a life insurance product, and most stockbrokers and financial advisors don't deal with life insurance. They feel that it's beneath them. So your financial advisor doesn't know about a life insurance product because he doesn't deal with it. He deals with stocks and mutual funds, and that's why he doesn't know about this product. And most life insurance agents don't know about the product, so it's a catch-22 for the client. The average life insurance agent doesn't know it, and the financial advisor doesn't know about it. And we feel that in the next 5 to 10 years, this life insurance retirement plan is going to hit mainstream America. And when Americans figure out that they're saving in their 401k plans for the government's retirement, because the government's going to take a huge chunk of that money, we feel that they're going to start to look for alternatives on tax-free income. So if you haven't answered the questions, find a life insurance agent that knows what they're talking about, understands this product, and go through an analysis. Because if you don't find the answers to your questions on retirement now, you're going to end up 30 years from now with the government taking most of your money through your qualified retirement plan. Most agents that I talk to have never heard of this product before, and we feel it's cutting edge, new type of life insurance product that's going to take over the market in the next 5 to 10 years. So if you haven't heard of this product, you need to get information on it.
I've been a practicing certified financial planner and a registered investment advisor, and today I'd like to introduce you to a powerful financial tool that can help you meet many of your financial goals. Equity Indexed Universal Life Insurance is the newest and fastest growing type of universal life. Once consumers hear about all of its many advantages over traditional permanent insurance, or even the buy term and invest the difference philosophy, they quickly become interested in learning more. Again, money can usually be taken out of the policy through withdrawals or loans on a tax-free basis to provide for emergencies or provide tax-free retirement income. Now, most equity indexed life policies have a floor and a ceiling called a cap on the maximum interest rate your policy will be credited with, depending on how well the S&P 500 does. The floor, or the worst case scenario, is usually between 0 and 2%, and that's the least amount your policy will be credited with in any one year, depending on the policy you choose. In years like 2008, where there was a big drop in the S&P 500, my insurance clients proudly tell me that 0 was their hero. In other words, a 0 return is many times better than a 37% loss. Of course, the 2% return in some policies was even better than 0 in 2008. But regardless, the main thing to understand is that your account value can never decrease based on what happens in the stock market. Your account value cannot go backwards because the stock market goes down. Your 401k can't say that. In years where the S&P 500 does well, your policy will be credited by an interest rate that is subject to a ceiling or a cap, which is usually between 11 and 15% a year in most policies. So when the actual S&P 500 index goes up by 21%, the interest rate credited to your account will be limited by the cap in your policy, perhaps 14%. But most people I know are extremely happy and can sleep well at night, knowing their policy can never lose money when the market goes down, and yet they can enjoy up to double-digit gains in years when the market goes up. And unlike in the S&P 500 index, your annual gains are always locked in and can never be lost by future market losses. This is huge. Those annual gains become principal and are never at risk, nor can they ever be lost when the market goes down again, which it always does.